Welcome friends back again. This is continuation of our discussion on SA 315 from where we left was regarding identifying and assessing the risk of material misstatement through the understanding of the entity and its environment. Now let's discuss internal controls. We discussed the definition of internal controls in part 1 of our discussion. Now the understanding of the internal controls, what controls are relevant for financial reporting, as not all controls are relevant. So we need to use our professional judgment to determine what controls are relevant. So the purpose is to enable us to ensure a reliable financial reporting, efficiency and effectiveness of operations, compliance with the laws and regulations, safeguarding of the assets, and the design, implementation and maintenance of internal controls, which will vary from size and the complexity of the entity. In a smaller entity, the internal control could be less structured and maybe more simple. We have our limitations. We could have a faulty human judgment. There could be a collision among employees and or of the management. There could be a management override of controls. Controls always has a benefit, but it also has a cost. So if your cost exceeds the benefits, then at times the controls may not be put in place. And the judgment on the nature and extent of risks assumed vis-a-vis controls. So this is what we need to actually look into. In a smaller entity, there will be fewer employees, therefore lesser segregation of duties, but there could be a closer management oversight or an owner oversight in this case. But there could be chances of the owner override of controls also. So we need to actually see what is applicable. So you have internal control, there could be manual controls, there could be automated controls. There are benefits obviously of automated controls. There will be consistency in the application, there will be timeliness, availability and accuracy of information. Additional analysis could be possible, there could be better monitoring, there could be reduced risk of circumvention of these controls, there could be better segregation of duties. So there definitely are benefits, but there could be risks also. Automated controls, if they are inaccurately designed, if there is an unauthorized access, unauthorized changes made to master files, unauthorized changes made to programs, systems. There could be also failure to make necessary changes to the programs or systems in case they need to be done. There could be inappropriate manual intervention in an automated control, and at times there could be an inability to just access the data. So there are benefits, there are risks. One needs to weigh the benefits and the risks, but obviously the benefits would outweigh the risks. Now, suitability of manual controls. So it's not that manual controls are totally bad. So in case where there are large, unusual or non-recurring transactions, where errors are difficult to design and predict, and where circumstances are changing too quickly and they could not be covered or captured by an automated control. And we need to monitor effectiveness of an automated control. I think somewhere down the line we need to also rely on manual controls over and above the automated control. But manual controls by large are less reliable as they can be easily bypassed. They could be ignored, they could be overridden, and there's a tendency to be error prone, and we cannot assume consistency, and they are not suitable for high volume recurring transactions, and obviously where control activity can be automated, obviously you need to go in for an automated control. So what are the factors we need to consider while framing and control or in understanding and control? Obviously materiality, the significance to the related risk, the size of the entity, the nature of the entity's business, the diversity and complexity of the operations of the entity, the circumstances that are applicable to the control. We need to understand how a specific control prevents, detects and corrects misstatement, the nature of complexity of the various systems in operations, the laws and regulatory requirements that may be applicable to the entity. So we need to understand the nature and extent of the relevancy of the controls to the audit. So we may need to understand the design of these controls and evaluate those designs and determine their implementation. We need to also see the procedures with reference to inquiry with various personnel in the entity. We need to observe the application of specific controls. We need to inspect documents and records, and we may need to trace a transaction end to end through the relevant information system relevant to the financial reporting. So understanding an internal control by itself will not be sufficient to test operating effectiveness unless there is an automation to ensure the consistency. Now the components of internal controls. Internal control has 5 components. One is the control environment, the control activities, the risk assessment procedures which are conducted in an entity, the information system, and the monitoring of these controls. And the various elements also. One is the communication and enforcement of ethical values is key to internal control, the assignment of authority and responsibility, the HR policies and practices in place, the organizational structure, the management's philosophy and operating style, the commitment to competence and participation actively of those charged with governance. So we need to evaluate the existence of ethical values vis-a-vis the culture, the strengths versus the deficiencies of the control environment, and the effect of the control environment on the risk assessment. So the risk assessment procedures, what we need to do is inquire, observe, and inspect. Now, what are the effects of assessment of risk on material misstatements because of the control environment? I think there could be a pervasive effect, and the control consciousness has to be driven by those charged with governance. A satisfactory control environment will reduce, but will and will not absolutely deter fraud. And a control environment in itself will not prevent or detect or correct a material misstatement, but a control environment will affect the auditor's assessment of the effectiveness of other controls and what he needs to test and the nature, timing, and extent of his testing. So in a smaller entity, you could have issues which could be quite different. Those charged with governance may not be independent and may not be outside members. The governance role may be taken by the owner itself. There may be no documentary evidence available on record to show the controls exist. The attitudes, awareness, and actions of the owner are very important in this case and needs to be very carefully noted. Now we have various elements and risk factors of a risk assessment procedure. The first is it starts with identifying the basic risks. We need to identify post the business risks and prioritize what are the significant risks. Then the probability or the likelihood of occurrence of these risks and what is the action we need to take to respond to those risks. So it's all about identification, prioritization, assessment of the likelihood and probability of the occurrence and the action or the response to be taken. And this would vary because of new personnel, new technology, new business models, restructuring, expanding into foreign operations, new accounting pronouncement which could be there, rapid growth, new or revamped information system, changes in the operating environment will all vary the risks. So at various points of time, the risk will vary. Risk is not a static factor. Risk is volatile and risk has a speed also. So one needs to be very proactive in identifying risk, prioritizing risk, assessing the risk, and the response to the risks has to be a continuous manner. Now, there have been entities which have failed to conduct risk assessment procedures effectively so as to identify material misstatements, and this could be maybe because of a material weakness in the entity's risk assessment procedures, and there could be an absence of the risk assessment procedures. So we need to discuss with management, we need to discuss how risks are identified and addressed, and we need to evaluate the appropriateness or otherwise of the documentation of the risk assessment procedures, and we need to ascertain whether there is a material weakness in risk assessment. Now, the information system also plays a very big part. The information systems help us to identify and record all transactions, basically all valid transactions, whether there is a timely and detailed description of transactions and a proper classification, the time period, whether they are correctly accounted in the time period, whether they are measured properly at a proper monetary value, and whether a proper disclosure and a presentation is made. So information system will have various aspects. Some of the material important aspects are whether the information system properly initiates, records and processes the entity's transactions, whether it maintains an accountability for related assets, liabilities and equity, whether it resolves correct processing of transactions, whether it processes and accounts for system or control overrides, whether it transfers information accurately to the general ledger, whether it captures all relevant information, and it ensures accumulation, recording, processing and summarizing as well as appropriate recording and reporting of information which is relevant to the financial reporting framework. So one needs to understand the process of significant classes of transactions, the procedure for initiation, recording, processing, correcting and transferring information to the GL and the financial statement, understand the related accounting record and the supporting information that is required, how all the information is captured, what is the process for preparation of financial statement, the accounting estimates, the disclosures, and what are the controls which are surrounding the journal entries which are passed. So we need to understand the communication, how the financial reporting roles and responsibilities are communicated, what is the communication between those charged with governance, what are the external communications which are made, and for a smaller entity, the information system will be less sophisticated, but they still play a very equal significant role, and understanding them is very important even in a smaller size entity. In such entities, the management may be less active, there may be a less documented description of accounting procedures, or there may not be sophisticated accounting records or written policies, and maybe you may not have to verify a lot of documentation, it will be more of inquiries, and there will be less structured communication. So for a smaller entity, the considerations will vary, but yes, again, information systems will play a very major role, and one needs to be very careful on how one evaluates the comprehensiveness and the robustness of the information system. Now, what are the control activities relevant to audit? So you may have performance reviews, you may have reviews to see that the information is processed correctly, proper segregation of duties are there are physical controls in place, so you have relevancies with reference to significant classes of transaction, account balances, the disclosures which are made, the decisions which are made which are relevant to risk assessment, the effectiveness of control need to be tested, whether substantive procedures are alone in itself sufficient or not, and whether there could be a possibility where the risk of material misstatement could be higher, then the control activities need to be performed would be much more. Again, for a smaller entity, the concepts may be more or less the same. Some controls may not be relevant due to direct owner oversight, and there could be some changes which could be specifically there which one needs to see. Now, understanding these controls is necessary for assessing the risk of material misstatement at an accession level and design appropriate audit procedures so that they respond to the risk appropriately. And what's the response even to IT risks? I think that needs to be seen. So we have in IT risks and controls, we have general IT controls and we have application controls. Now general IT controls with reference to policies and procedures, we may apply to maintain the integrity of information and security of data, and they may cover data center, they may cover network operations, they may cover system acquisition, change, maintenance, changes in program, access, securities, application system acquisition, development and maintenance, licensing. You may even have application controls applicable to processing of individual transactions so that they ensure authorization, completeness, accuracy and processing of transactions. So the coverage has to be with reference to initiation, recording, processing, reporting of transactions and all other financial data. So it's a process which one needs to do to assess effectiveness of internal control performance over time. Now that may involve assessing effectiveness of controls on a timely basis and taking necessary remedial action. Now that may be done by ongoing separate evaluation. Maybe you could have communications from external parties, also regulators, which may need to see on how basically regulators have found any issues or gaps. So one finally needs to understand what are the major monitoring activities which one needs to do. What is the remedial activity the entity is doing so as to rectify the deficiency in the control. Internal audit function, if any existing in the entity, plays a very crucial role and one needs to evaluate the efficiency and efficacy of internal audit. Sources of information which are used in monitoring activities, how relevant and reliable such information is, and the basis on which management assesses the reliability of information. And in a smaller entity, it will be generally accomplished more by the owner's close involvement in the operations. So you will have risks at the financial statement level, you will have risk at the accession level. You will have a risk at the accession level during the year, at the year end, and also in the presentation and disclosure stage. At a financial statement level, you will have a risk which may arise from weak control environment. There may be circumstances that may increase the risk at an accession level, and there might be relating pervasively to a financial statement. So one needs to be very careful in this. At an assertion level during the year, one needs to see the occurrence, completeness, accuracy, cutoff and the classification. At the year end, one may need to see the existence, the rights and obligations, the completeness, the valuation and allocation of resources. And maybe for a presentation and disclosure, one needs to see the right and obligations, the completeness, the classification, the understanding, the accuracy, the valuation and the occurrence. So the audit procedures will vary. One needs to identify risks, one needs to understand the entity and its environment, one needs to assess the identified risk, one needs to evaluate the effect of the identified risks on the financial statements, one needs to relate these identified risks to the fact that there could be a possible misstatement at the assertion level, and once you have risks, you consider the relevant controls and relate them to the assertions and consider the likelihood of misstatement and the magnitude also. It's basically a function both of the probability and the impact. Now, there would be risks which may require special audit consideration. This would be in case there could be any significant risk which depend on the auditor's judgment. Now, those factors which one needs to consider, primarily one, the fraud risk, the recent significant economic, accounting and other developments, the complexity of transactions, the related party transactions, the subjectivity in measurement of financial information, and there could be risks outside the normal course of business. So all these risks one needs to consider. One needs to consider the relevant controls on those risks. So you may have significant non-routine transactions due of an unusual nature, size, which may occur infrequently. It might be in areas of management intervention to specify accounting treatment, management or manual intervention for data collection, complex calculations, accounting principles, nature of non-routine transactions, where it would be difficult to implement effective controls over the risk. And there could be matters of judgment, which regards accounting estimates for significant measurement, and there could be uncertainty. And this judgment may be subjective, complex, and require assumptions which may impact future events. And accounting principles for accounting aspects could be subject to different interpretations, and that's something which an auditor needs to consider. So when auditor determines that a significant risk exists, he needs to obtain an understanding of the entity's control and the control activities to those risks. He needs to understand whether the entity has designed and implemented controls for those significant risks. How management responses to those risks? What are the control activities? What is the documentation? What is the approvals in place from those charged with governance? What are the assessments for maybe one-off random events? And inappropriate responses of the management to significant risks is a clear sign of a material weakness in an internal control. And there are risks where substantial procedures alone may not suffice, and that would all depend on the auditor's judgment. And this may relate to inaccurate or incomplete automated recording of routine or significant classes of transactions. Substantive procedures alone are not possible in a fully automated accounting system. Sufficiency and appropriate of audit evidence depends on its accuracy and completeness, and potential for misstatement is greater if appropriate controls do not operate effectively. Now, you might need revision of risk assessment procedures if you get evidence from further audit procedures. You get new information, so you'll need to revise the assessment and modify the planned audit procedures in case they are inconsistent with the original audit evidence. So revision of risk assessment is something which the auditor should consider. And finally, we come down to the responses to those assessed risks. What are the things we need to document? So we need to discuss the responses what we have had with the engagement team and the significant decisions which have been reached. So we need to document that. The key elements of understanding of the entity, its environment and its internal controls. The identified and assessed risks of material misstatement both at a financial statement level and at an assertion level. Risks that may require special audit consideration, and risks for which substantive procedures alone do not suffice. So this documentation is a matter of audit judgment, but this is the mandatory documentation which we should have as per the requirements of SA 315. And the form and extent of documentation will depend upon the nature, size and complexity of the entity and the internal controls, availability of the information from the entity, the audit methodology which we have used, and the technology which we are using. So we conclude our discussions on SA 315, which was of two parts. Thank you.